So now you're trading time for money, and the moment you stop working, your income just quietly disappears, which feels normal until you realize that's not stability, that's dependency dressed up like a career. And then every time you earn money, it quietly gets split before you even touch it. So the harder you work, the more disappears first, which is a strange system that somehow rewards you by taking more. But then your income goes up and somehow your expenses follow right behind it. So you upgrade everything around you and call it progress while your actual freedom just quietly stays exactly where it was. And then you start buying things you can't actually afford using money you haven't earned yet, which feels great in the moment until you realize you're just committing your future time to pay for your past decisions. So saving money does protect you from falling apart, but it doesn't actually move you forward because safety and freedom are not the same thing, even though most people spend their whole lives confusing them. So the real shift happens when you stop focusing only on earning and start building things that pay you back over time, because income pays your bills, but ownership is the only thing that actually builds wealth. So this is the middle class, where money comes in and then quietly flows right back out again. And the strange part is nothing actually stays, which means you're working constantly without really moving anywhere. And even though you're doing everything right, earning, saving, staying responsible, you still feel like you're falling behind, which doesn't make sense until you realize the system itself was never designed to push you ahead. So when your income increases and your lifestyle immediately upgrades with it, you feel like you're progressing, but in reality, your financial position hasn't changed at all. It just looks better from the outside. Ding! And then you start buying things you don't actually need just to signal progress to people around you, which feels satisfying for a moment until you realize none of it is actually improving your long-term position. So while most people stay focused on earning more money, the real difference comes from what you actually own, because income pays your bills, but ownership is what quietly builds wealth in the background. And that's when you realize the system isn't actually broken. It's just designed to keep you comfortable enough to stay in it, but not free enough to leave, which is why most people never question it. So when you finally ask if saving money is enough, the uncomfortable answer is that it protects you from falling apart, but it doesn't actually move you forward or get you any closer to real freedom. So instead of money coming in and immediately going out, the real shift happens when money starts flowing into assets, and those assets begin sending money back to you again over time. And that's when you slowly start shifting your focus away from just earning money toward actually owning things, because earning requires constant effort, but ownership keeps working even when you don't. Because income will always help you survive and pay your bills, but ownership is the only thing that actually builds long-term wealth, which is why the difference between the two matters more than people think. And that's when it finally clicks that the system isn't broken at all. It's actually working exactly the way it was designed to, keep you comfortable enough to stay, but never free enough to leave. So now the real question is whether the middle class is actually trapped inside a system like this, or if people are just making choices that keep them there, because the answer is probably uncomfortable either way. Because if you keep following the exact same path that everyone else is on, then you're almost guaranteed to end up in the exact same place, which explains why most people never really get ahead. So the trade you're really making isn't obvious at first, because you're choosing comfort in the present without realizing you're quietly giving up freedom in the future, which feels fine until it's too late. And the reason this cycle is so hard to escape is because it doesn't feel like a trap at all. It just feels like normal life, which is exactly what makes it so effective. So over time, what you're really spending isn't just money, it's your future time, because every decision you make today quietly locks in how much of your life you'll have to trade later. And the way out isn't some big dramatic change. It starts with small shifts in how you think about money and where you decide to put it over time. Because no one really escapes this system by doing exactly what they were told to do, which is why understanding how money actually works is the only thing that gives you a real chance. Ding! So every time things don't work out, the advice is always to just work harder, earn more, and push further, which sounds logical until you realize you're just reinforcing the exact loop that's keeping you stuck. And being constantly busy starts to feel like progress because you're always doing something, but movement isn't the same as direction, which is why people can stay active for years without actually getting ahead. So having a stable job feels like security because the income is predictable. But that stability depends entirely on something you don't control, which makes it far less safe than it appears. And it's not always big expenses that keep you stuck. It's usually small, repeated leaks that quietly drain your money over time, which makes it harder to notice, but much harder to fix. So the problem with this entire system is that the consequences don't show up immediately, which is why it feels fine in the beginning, and only becomes obvious much later when it's harder to change. And at some point, you either question how the system works or you keep following it, hoping things will change on their own, which almost never happens because the system doesn't reward awareness, it rewards participation. So over time, the pressure just becomes normal and you stop questioning it because everyone around you is dealing with the same thing, which makes stress feel like a standard part of life instead of a signal. And every time you get paid, it feels like a reset because your balance goes up again, but within a short time, everything gets distributed and you're back to where you started. So even when you try to move ahead, it feels like something keeps pushing you back down, which is because the system creates limits that are hard to see, but very hard to break. And you keep waiting for things to improve later because you believe the effort will eventually pay off, but the timeline keeps stretching, which makes you stay longer than you originally planned. And seeing everyone else doing the same thing makes it feel correct because it creates social proof, even if the outcome isn't actually working, which makes it harder to question the path. And the moment you start seeing these patterns clearly is when everything begins to change, because awareness is what breaks the illusion, even though it doesn't immediately change your situation. So even when your money is just sitting safely in cash, it's quietly losing value over time because inflation keeps reducing what it can actually buy, which means doing nothing is still a financial decision. So saving money in isolation feels responsible, but without investing, it never really grows, which is why people who only save often fall behind those who understand how to make money work for them. And the reason investing matters so much is because of compounding, where small, consistent returns start building on top of each other over time, which eventually creates growth that looks disproportionate to the initial effort. Active income requires your time and effort continuously, but passive income comes from systems that keep generating money even when you're not working, changing how your time is used. And avoiding risk completely might feel safe, but not investing at all is also a risk because your money loses value over time, which makes inaction just as dangerous as making poor decisions. So instead of focusing only on how much money you make, the real shift is paying attention to how money flows in and out, because controlling cash flow is what ultimately determines financial stability. So even small fees that look harmless at first can quietly reduce your long-term returns because they compound against you over time, which means what you keep matters more than what you earn. So putting all your money into one place might feel simple, but it increases your risk because if that one thing fails, your entire position is affected, which is why spreading risk matters. And having all your money locked into things you can't easily access can create problems because opportunities or emergencies require liquidity, which means access to cash is just as important as growth. Using borrowed money can increase returns when things go well, but it also increases risk when things go wrong. Which means leverage works both ways. And how your money is taxed can significantly affect how much you actually keep, which is why understanding tax efficiency is just as important as making money in the first place. Starting earlier often has a bigger impact than trying to invest larger amounts later. So when interest rates go up, borrowing becomes more expensive and spending slows down, which affects everything from loans to investments, meaning the cost of money itself plays a huge role in financial decisions. And your credit profile affects how cheaply you can borrow because lenders price risk into every decision, which means better credit reduces costs, while poor credit quietly makes everything more expensive. So the difference between assets and liabilities is simple. Assets put money into your pocket, while liabilities take money out. Which means what you buy matters more than how much you earn. And budgeting isn't about restriction, it's about knowing where your money is actually going. Because without visibility, it's almost impossible to control spending or improve your financial situation over time. So, every financial decision has a hidden cost because choosing one option means giving up another, which is why where you put your money matters just as much as how much you invest. And in most cases, consistent small investments over time outperform irregular large ones because consistency allows compounding to work more effectively, which is why discipline matters more than timing the market. So having an emergency fund acts like a buffer between you and unexpected expenses, because without it, you're forced to rely on debt, which makes short-term problems turn into long-term financial setbacks. So investing fixed amounts regularly helps reduce the impact of market fluctuations because you buy at different prices over time, which lowers the risk of putting all your money in at the wrong moment. And over time, some investments grow faster than others, which can shift your risk level, so rebalancing helps bring your portfolio back to its intended allocation instead of letting it drift unintentionally. So it's not enough for your money to grow, it needs to grow faster than inflation, because otherwise your real purchasing power is still declining, even if the numbers appear to be increasing. So deciding between paying off debt and investing depends on the interest rate because high interest debt usually costs more than potential investment returns, which makes eliminating it often the better financial move. And earning a high income doesn't automatically mean you're building wealth because what really matters is your net worth, which is the difference between what you own and what you owe. So before you start investing heavily, it usually makes sense to build a basic safety buffer first, because investing without stability can force you to sell at the wrong time during unexpected situations. And insurance doesn't build wealth directly, but it protects you from large financial losses, which means one unexpected event doesn't wipe out years of savings or progress. So relying on a single source of income increases your financial risk, because if that one stream stops, everything is affected, which is why having multiple income streams improves stability.
And delaying taxes on your investments allows more money to stay invested and compound over time, which can significantly increase your long-term returns compared to paying taxes every year.
So even small percentage costs inside investment funds can reduce your overall returns because they are deducted continuously, which makes low-cost options more efficient over long periods. And holding too much idle cash in a portfolio can reduce overall returns because that portion isn't growing, which creates a drag effect compared to keeping more money invested productively. So trying to perfectly time the market is extremely difficult because prices move unpredictably, which is why staying invested over time often produces better results than waiting for the perfect moment. And matching your investments with your time horizon matters because short-term needs require stability, while long-term goals can handle more volatility, which helps you choose the right strategy. So some assets perform better during inflation because they can adjust with rising prices, which helps protect purchasing power compared to holding only cash, which loses value in inflationary periods. And fixed return investments provide stability but limited growth, while variable return investments fluctuate but offer higher potential returns, which means balancing both helps manage risk and growth together. So during market downturns, having some liquid assets allows you to handle expenses without selling investments at a loss, which helps protect your long-term portfolio from unnecessary damage. And how you allocate your money across different assets determines your overall risk and return, which is why having a clear allocation strategy is more important than chasing individual investments. So at this point, the real question is whether you're actually building assets that generate income or just earning and spending continuously, because that difference is what ultimately decides your long-term financial outcome. Because understanding how money actually works is what allows you to make better decisions over time. And if you keep learning and applying these concepts, you gradually move from just earning money to actually building wealth.